Hi, my name is Linda Eedes and I'm a senior member of the ReCM investment team. I'm going to talk to you today about why ReCM doesn't have a top-down asset allocation process and why in fact our asset allocation is entirely a byproduct of our bottom-up investment decision making. Asset allocation can broadly be divided into two separate categories. Strategic or fixed asset allocation, where the asset classes are determined by the risk of those asset classes and the risk profile of the investor. And tactical or dynamic asset allocation, where you allocate dynamically to various asset classes based on where you see opportunities. Let's deal with strategic or fixed asset allocation first, why we don't think this is a particularly good idea. Well, strategic asset allocation is based on volatility as a measure of risk. What do I mean by that? The risk of each asset class is determined by how volatile it has been historically. So for instance, bonds would be considered a low-risk asset class, and equities would be considered a higher-risk asset class, given it has higher volatility over time. Now, we don't think volatility is a very good measure of risk when it comes to individual investors. Investors aren't usually concerned with upwards and downwards price movements equally. What we find is that most investments care more about downwards price movements than they do about upwards price movements. And importantly, they care about the risk of permanent capital loss. So volatility in that sense isn't particularly good as an accurate measure of risk for investors. The other problem with strategic or fixed asset allocation is that it's valuation indifferent. What do I mean by this? Your asset allocation to a various asset class would be constant, irrespective of whether those assets are expensive or cheap at the time that you do the asset allocation. Now, if you look at an asset class such as bonds, which are very expensive today with yields at all-time lows, allocating to that asset class isn't necessarily less risky than allocating to other asset classes just because it's been less volatile historically. Prices are very expensive, and the price you pay is going to ultimately be the key determinant of your returns over time. So that's why strategic asset allocation for us doesn't make much economic sense. Let's talk about tactical or dynamic asset allocation, where you allocate based on a top-down process. Well, to do that, you've got to firstly start by forecasting economic growth. Then you've got to forecast the interest rates for that region. Then you've got to forecast the sectors that'll do well under that scenario. And then lastly, decide on the stocks you want to invest in. Now, those are four critical things that you have to forecast. Let's say your track record is impeccable. You're in fact the best forecaster of all time, and you get this right 70% of the time. If you times 70% by the power of 4, you get 0.24, 24%. Your chance of getting all of these things right is 24%, not very good. We know that forecasting is near impossible to do consistently. You might get it right once or twice, but can you get it right again and again and again? And more importantly, is economic growth really a good determinant of investment returns? Look at South Africa, for instance. Over the last decade, we've been one of the best performing equity markets in the world. Yet our economic growth has actually been fairly pedestrian. In real terms, it's been 2 to 3%. However, if you look at an economic region such as China, which has had spectacular economic growth, the investment returns have been very pedestrian. So looking at where economic growth is going to be generated and allocating based on that hasn't necessarily been a very good process historically. So that's our problem with a top-down process which starts with macroeconomic variables. So how do we asset allocate at ReCM? As I mentioned before, it's a byproduct of where we find bottom-up value. Now, the risk that we believe investors are most concerned with is the risk of permanent capital loss. How do you protect your investors from permanent capital loss? You make sure that you never buy assets when they're trading at prices well above what they're worth. So valuations are absolutely key. Asset allocation is a very important determinant of overall returns, but how you asset allocate is even more important. If you buy cheap assets, you are likely to get good returns over time. If you buy expensive assets, your returns are likely to be poor over time. So allocating from the bottom up based on that will ultimately deliver the best real returns with protection against permanent capital loss.